The profit and loss statement, P&L or income statement, is one of the three major financial statements. In this video, I'll explain what the profit and loss statement is and how you can use it in your business for its financial health. Subscribed yet, make sure you hit the subscribe button and turn on the bell so you know next time a video is uploaded about all things business money. I am Annette Ferguson, Chartered Accountant and Certified Profit First Professional, and I run Annette Co, a UK-based accounting firm. A profit and loss statement reports a business's income, expenses, and total profit or loss over a specific time period. It's one of the three major financial statements that a business prepares to assess its financial health alongside the balance sheet and the cash flow statement. The profit and loss statement doesn't just show the profit or loss of the business, it shows the income and expenses that are related to generating that profit or loss. The profit and loss statement is also known as the income statement, or you may have heard it referred to as a P&L. All these words are interchangeable. The profit and loss statement is essentially used to analyze how well you turn business expenses into revenue. It can help identify whether you have the ability to generate earnings in the long run and help you make important business decisions, like whether to invest in new equipment or change a strategy. It is important to note that if you are VAT registered, the profit and loss account numbers are excluding VAT. So we start with the income section, the revenue or sales. Your revenue earned through selling your products or services. This is the first section that appears in the profit and loss account. The next section we see are the cost of sales or direct costs. These are the total of the direct costs incurred to sell your products and earn revenue. This can include things like cost of labor and materials. And the next line we see is the gross profit. The gross profit is calculated by subtracting the cost of goods sold from the revenue. At this point, if you are looking at a profit and loss statement as part of a set of management accounts, you might also see the gross profit percentage, also called gross margin. That will not be shown in a set of statutory accounts, those that are submitted to Companies House and HMRC. The gross profit margin is the gross profit divided by the total revenue. And the higher the gross profit margin, the better. If this video is helpful to you so far, do remember and hit that like button. Next, we have the indirect costs, also known as overheads or general administrative costs. These can include things like advertising and promotion expenses, which are costs associated with marketing your business to attract clients. This can include payment for digital or print advertising, along with general and administrative expenses. The administrative costs associated with running your business, including salaries, rent, office supplies, and travel expenses, and depreciation expenses. Depreciation is an accounting adjustment and refers to the practice of spreading out the cost of a long-term asset over its useful lifespan. It's often done with vehicles and large equipment. And that takes us to the operating profit. This is the gross profit minus those advertising and promotion expenses, general and admin expenses, and depreciation expenses. The gross profit can also be known as the EBIT, EBIT, standing for earnings before interest and taxes. These are exactly the same thing. And this is essentially the profit before tax and before interest charges. In some instances, between the operating profit line and the profit on ordinary activities before tax, we will see finance charges. For example, if the business has borrowing and has been paying back loans, we will see the interest element of financing costs shown here. Then we have the summary of profit on ordinary activities before tax. And after that, we would expect to see, where appropriate, a tax charge in the profit and loss account. This then brings us to the profit after tax, or net profit. It's derived by subtracting the interest and tax from the operating profit of the business. It can also be called net income as well, which can be a little bit of a confusing term. The total revenues minus the total expenses is the last line in the income statement. If the number is positive, your business is reporting a profit, and if it is negative, you're recording a loss for that reporting period. In management accounts, we might see a net profit margin also shown here. That is the net profit divided by the revenue. And the higher the net profit margin, the better. A higher net profit margin means that the company is more efficient at converting sales into actual profit. In this example, we can see comparative periods. We've got February, January, December, November. It is typical to see comparative periods when looking at a profit and loss account. It can help you evaluate business trends for decision making and also spot if anything is missing. In annual accounts, we would show the previous year as a comparative, whereas in management accounts, it would be typical to show one or more of the previous months. If you are struggling with accounting for your business, I would love to help. Do reach out to me at yt@annetteco.co.uk and let me know how I can support you. Thank you so much for watching. Hit the like button, subscribe, and I'll see you in the next video.